Our market monitor tonight is looking for a 7% gain in stocks next year at best, but he says you can do better if you fully embrace the idea that 2014 will be a stock picker's market. He's Kevin Caron, a portfolio manager at Stifel Private Client Group, and he joins us tonight by phone. Kevin, welcome and Happy New Year to you.
Happy New Year to you, too.
Our chief economics correspondent, Steve Leisman, says that 2014 is likely to be a year of synchronized global growth that bodes well for the markets. In other words, the U.S., Europe, Japan, and maybe even emerging markets will grow. Do you think that's one of the key follow-throughs for 2014?
Well, I do think so. I think the world is accelerating. We saw growth in the United States reach 4% in the third quarter. We're seeing growth starting to lift around the world, Europe in particular. We're seeing less budgetary drag coming out of Washington, D.C., less uncertainty. Consumers feel better, profits are strong, and the stock market has enjoyed its best run this year since 1997. So we do have some very good momentum going into 2014, and stock market is certainly reflecting that.
And you say, though, even in that positive environment, you have to be very selective on which stocks you do buy. And you have a couple of tech stocks to tell us about. Let's start with Cisco, which at $22 has had a pretty bumpy year looking at this chart here.
Yeah, so Cisco, obviously the networking giant, is a stock that has lagged this year. It's lagged by about 10% the overall market this year. And one of the big nagging concerns with Cisco has been emerging markets. They were slow. There was a big drag out of China, but I think that fades over time. So I think ultimately what's going to drive Cisco is the rapid rise in bandwidth. That's going to continue. More video, more mobility, more collaboration. You can buy the stock at a discount, 13 times earnings. 3% yield, big boost in that dividend last year. I think you can earn 17% in the stock.
Well, let's spend a few seconds on Oracle, another of your picks, Kevin.
Yeah, this is a very big company, mission-critical enterprise solutions. The company has very aggressively embraced cloud computing. They are going out and making some very significant investments in that space. I think the stock may have gotten a little bit ahead of itself. I would like it to buy it on a pullback. But they are going to be with us for quite a long time, $13 billion in net cash. They're doing that much every year in free cash flow, so it's going to be with us. And their very large installed base of customers means stability for the company going forward.
Kevin, tell us quickly why you like IBM.
Well, again, China has been weak. That has put pressure on the stock. Revenues have been under pressure. The stock is trading about 185. I think it goes to 220. We like it here at Stifel. We think a 21% rate of return is about right when you include the dividend. Again, the near-term issues relating to weakness in business spending, I think, go away as 2014 carries on. China becomes less of a drag. And Warren Buffett likes the stock, 12 times earnings. I think that's a very good company. With
Buffett's endorsement is second only to yours, Kevin. Thanks very much. Kevin Caron, have a great New Year. We appreciate you being with us. Do you have any disclosures on those stocks? Do you own any of them or in your portfolios?
I don't own them personally. Stifel is looks to do investment banking with all companies out there. We make markets in these stocks.
All right, Kevin, thanks very much. Happy New Year. He's portfolio manager at Stifel Private Client Group.